Did you know that while you're watching this video, you could be losing or gaining thousands of dollars? It's not magic, it's the time value of money. Every second that passes is an opportunity to grow your wealth or watch it slip away. So, are you ready to unlock the secret to making time work for your money? Today, we're diving into a game changing concept: the time value of money. It's not just some dusty economic theory. It's the key to unlocking your financial future. Whether you're saving for a new ride, planning your dream vacay, or aiming for that sweet early retirement, understanding this principle is your golden ticket. That's why today I'll take you to understanding the time value of money, why every second counts. If you're new to the channel, hit that subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. Alright, let's be honest. Most people think of money as this static thing, like it's just chilling in your wallet or bank account, waiting for you to make a move. But here's the truth bomb. Money is always on the move, even when you're not looking. So what's the big problem? Ignoring the time value of money is like trying to win a race with your shoelaces tied together. You might think you're making progress, but you're actually falling behind with every step. Let me break it down for you. Scenario A. You've got a cool $1,000 burning a hole in your pocket. You think, I'll just keep it safe under my mattress for a rainy day. Sounds responsible, right? Wrong. After 10 years, that same $1,000 might only buy you $800 worth of stuff due to inflation. You've literally lost money by playing it safe. Scenario B. Your buddy invests that same $1,000 in a diversified portfolio. 10 years later, they're sitting pretty with $2,000 or more, depending on market performance. They've doubled their money while you've been snoozing on yours. See the difference? By ignoring the time value of money, you're not just missing out on gains. You're actively losing purchasing power. It's like running on a treadmill thinking you're making progress. But in reality, you've just been staying in the same spot while the world moves forward. This misconception leads to all sorts of financial facepalms, like putting off investing because you think you're too young, choosing the wrong savings vehicles, or not negotiating for better terms on loans. It's a silent wealth killer, and it's time we put a stop to it. That's why we're going to dive deep into the time value of money. And trust me, it's going to be more exciting than finding an extra fry at the bottom of your takeout bag. Let's break this down into bite-sized nuggets that will make you the smartest cookie at your next dinner party. First, let's talk about present value. Picture this. You've got a time machine, stick with me here, and future you sends a message saying, "Hey past me, I need $10,000 in 10 years. Now before you panic and start selling your vintage Pokemon cards, let's talk about present value. Present value is like financial reverse engineering. It's figuring out how much money you need to reach your future goal. It's the answer to the question, if I invest X amount of money today, how much will I have in the future? Or in our case, how much do I need to invest now to have $10,000 in 10 years? Here's where it gets spicy. The amount you need today is actually less than $10,000. Why? Because money grows over time. Like that science experiment you did with mold back in middle school, but way less gross and way more profitable. Let's say you can earn a 5% annual return on your investments. To have $10,000 in 10 years, you'd only need to invest about $6,139 today. Mind-blowing, right? That's the power of present value. It shows you how to make your future goals more achievable today. Number 2. Future value. Now let's flip the script and talk about future value. If present value is like planting a seed, future value is the mighty oak it becomes. It's what happens when you let compound interest work its magic. Imagine you've got $1,000 to invest. You could buy 200 lattes, or you could invest it and watch it grow. Let's see what happens over time with different interest rates. At 5% annually, in 20 years, you'd have about $2,653. At 7% annually, your money doubles in about 10 years. And in 20 years, you'd have $3,870. And at 10% annually, hold on to your hats, in 20 years, you'd be looking at $6,727. It's like your money is at the gym, pumping iron while you sleep. The higher the interest rate, the more intense the workout, and the bigger the gains. But here's the kicker. This isn't just about the interest rate. It's about time. The longer you leave your money to grow, the more dramatic the results. It's like the difference between a quick HIIT workout and training for a marathon. Both are good, but one will take you much further. Number 3. Interest rates. Now let's talk about interest rates. They're like the seasoning in your financial recipe. Get it right, and your money will be chef's kiss delicious. Get it wrong, and, well, it's like putting ketchup on ice cream. High interest rates are your best friend when you're earning them, and your worst enemy when you're paying them. It's a double-edged sword that can either build your wealth or slice through it faster than a hot knife through butter. But wait, there's more. Interest rates don't just affect your investments. They impact every financial decision you make. For example, let's look at mortgages. A 1% difference in your mortgage rate could mean tens of thousands of dollars over the life of your loan. It's the difference between a house and a house with a killer home theater system. Second is credit cards. High interest credit card debt is like a financial tapeworm, eating away at your wealth from the inside. Always pay more than the minimum, or that $1,000 shopping spree could end up costing you $2,000 or more. And finally, student loans. Understanding interest rates can help you decide whether to pay off loans aggressively or invest that extra cash. It's a financial yoga class, all about finding the right balance. Number 4. The compound interest miracle. Let's talk about the 8th wonder of the world, compound interest. It's like a snowball rolling down a hill, getting bigger and bigger as it goes. Here's a mind-bending fact for you. If you invest $5,000 today and add just $100 per month for 30 years at a 7% annual return, you'll end up with over $180,000. That's turning your Netflix subscription money into a luxury car. And finally, number 5, the inflation dragon. Before we wrap up this whirlwind tour of the time value of money, we need to talk about its arch nemesis, inflation. Inflation is like a stealthy dragon, quietly breathing fire on your money and eroding its value over time. On average, inflation runs about 2 to 3% per year. This means that $100 today will only buy you about $74 worth of stuff in 10 years. It's like someone secretly shrinking your dollar bills while you're not looking. This is why just saving money isn't enough. You need to invest to outpace inflation, or you're essentially moving backwards. It's like trying to climb up a down escalator. You need to move faster than it's going down just to stay in place. If you're still confused on how this all works, how about I give you an example? Let's meet the twins of time, Timely Tim and Procrastinating Pete. On their 25th birthday, Tim decides to invest $5,000 a year for just 10 years, then stops completely. Pete, thinking he has all the time in the world, waits until he's 35 to start investing $5,000 a year, but he keeps at it for 30 years until retirement at 65. Both of them earn an average 7% annual return. Now, drumroll please. At age 65, Timely Tim, who only invested for 10 years, ends up with a whopping $600,000. Procrastinating Pete, who invested for 30 years, has $540,000. Wait, what? Tim invested for just 10 years and ended up with more money than Pete, who invested for 30 years? That's right. Tim's total investment was $50,000, while Pete's was $150,000. Yet Tim came out ahead. This isn't just some financial magic trick. It's the explosive power of the time value of money. Those extra 10 years gave Tim's money more time to compound and grow, like a financial snowball rolling down a hill. The moral of the story? Time is literally money. Every year you wait to start investing is like leaving a pile of cash on the table. It's the difference between retiring in a beachfront villa and a studio apartment with a view of a parking lot. And well, that's basically understanding the time value of money. Why every second counts. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.